Michael Burry just warned that this may be the last bear market rally before we crash to the bottom, just like in 2001. First, the US NOTAM system crashed, resulting in all flights being grounded. The FAA said that files were unintentionally deleted, causing the crash. Tuesday morning, the New York Stock Exchange halted 90 plus stocks after a technical error, moved $40 billion plus in market cap. Is our technology really that fragile? Or the cyber attack is getting that serious? So far in the first month of 2023, US raises debt ceiling for the 79th time since 1960. 60,000 plus tech employees laid off. Average new car payment hits record $800 a month. 70% plus of economists expect a recession. And now New York Stock Exchange mysteriously halts trading for 90 plus stocks, making 20% plus moves in those stocks within minutes. Has uncertainty ever been this high? And yet the S&P 500 seems to want to move higher. Is this another bull trap rally? Is Michael Burry right about the similarity between this market and 2001? Why I believe interest rate will go lower. I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do. And push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You need to be my client, don't you? From my last video, Lacey Hunt said he believes last November is when the recession has started. So here are the layoffs since November. Number 1, Ford, 3,200 employees. Number 2, Amazon, 18,000 employees. Number 3, Wayfair, 10% of employees. Number 4, Goldman Sachs, 3,000 employees. Number 5, Twitter, 7,700 employees. Number 6, Peloton, 12% of employees. Number 7, Microsoft, 10,000 employees. Number 8, Google, 12,000 employees. Layoffs are beginning to spread beyond tech. This is the start of a stagnant economy. Is secular stagnation over? I do not think so. Today's inflation will not last, but I believe that low rates will. Secular stagnation refers to economies suffering from structurally low private demand, requiring very low interest rates to sustain demand and achieve potential output. Indeed, requiring interest rates so low that they are lower than the growth rate. The empirical evidence was indeed overwhelming that most economies were in such a state. Real estate rates, interest rates adjusted for inflation, had steadily declined since the mid-1980s. and were much lower than growth rates, indeed, typically negative. Disagreeing about secular stagnation with the first macroeconomist to identify it rightly as contemporary phenomenon is something that one should do very carefully. Because I believe that global secular stagnation was and is driven by deep structural factors that neither lockdown nor inflation have done anything to reverse. Once central banks have won the fight against inflation, which they will, we shall most likely return to a macroeconomic environment, not dramatically different, at least in this respect, from the one before lockdown. That means that safe interest rates, that is, rates for assets with no risk of default, will be low again. Why do I believe rates will remain low? The decline in safe rates on government bonds, adjusted for expected inflation, has been a steady and global one since the 1980s. The decline may have started earlier in Japan, but essentially all advanced economies shared the condition until the post-lockdown inflation of 2021. This trend did not result from particular events, say the global financial crisis or the 2020 crisis. While these led to temporarily lower rates, these lower rates were short-lived deviations from an underlying downward trend. This process was indeed interrupted by the rise of inflation starting in 2021, which has forced central banks to increase interest rates to get inflation down to target. But even now, at what may be close to the height of central bank interest rates in their fight against inflation, real interest rates are still surprisingly low. In the United States, the 10-year nominal rate on government bonds is currently 3.4%, while the 10-year inflation forecast by the Congressional Budget Office is 2.4%, implying a 10-year real rate of 1.0%. At the same time, the 10-year CBO growth forecast is 1.7%, implying that even today, the 10-year forecast for R minus G is still negative, minus 0.7%. Investors and even the Fed can be wrong. However, indeed, they did not predict the current increase in nominal rates. So one must dig deeper. Leading indicators roar recession as NASDAQ soars to the best start to years since 2001. U.S. macro data has been ugly recently, crushing the soft landing narrative. And today we get the clearest signal of that imminent hard landing recession, as leading economic indicators tumbled for the 10th straight month, plunging most since the GFC, continuing to signal recession for the U.S. economy in the near term. Growth stocks have dramatically outperformed value stocks since the start of the year, as the value growth ratio topped out perfectly at the cliff before the lockdown-driven easing fest. The start of the Lunar New Year offers an additional tailwind to the 36% jump in Bitcoin so far in 2023. If history is any guide, every year since 2015, the price of the biggest cryptocurrency was higher 10 days after the festival's onset. A 100% win rate. Finally, Bloomberg's Financial Conditions Index is at its loosest since before the Fed started hiking rates in March 2022. I simply cannot believe that after all the jawboning in the last 2 weeks, as well as the explicit acknowledgement in FOMC minutes, that Powell will not have to aggressively push back against this unwarranted easing. Legendary investor Jeremy Grantham says the stock market could crash 50% this year as the bubble enters its final phase. Grantham said the ongoing deterioration of the financial conditions will be capped off by a downturn in the housing market, representing the final phase of the stock market bubble that should help drive the S&P 500 to 3,200 by year end. In a worst case scenario, Grantham sees the S&P 500 falling as much as 50% to about 2,000. And investors shouldn't look to the Federal Reserve for help in the form of interest rate cuts. According to Grantham, that's because in 1929, 2000, and 2007, the largest part of the stock market decline occurred after the first rate cut from the Fed. Despite the painful recent experiences of the 2000 and 2008 bear markets, we continue to hold on to the hope that the first rate cut will be guaranteed to kill the bear. We really are an incredibly optimistic species that these very negative examples, despite being clear and recent, are so easily ignored. Grantham said. I think Grantham is agreeing with Michael Burry, and they are right. What I think will happen first is that TLT will lead the NASDAQ higher before the final crash happens. TLT will continue going higher as the stocks crash down. This is my client Teddy Eazzy's book, Wicked Pussy Perfume. It is an erotic novel, such an amazing book. And my book, Rainbow Focus. You are such a good boy for watching my video right till the end. Bye.